Hi, everyone. Welcome to another edition of Seven Market Movers. My name is Aya Yoshioka. I'm the Portfolio Consulting Director and Senior Investment Strategist here at Wealth Enhancement. And I'm super honored today to be joined by Gary Quinzel, our VP of Portfolio Consulting, and Doug Huber, our Deputy Chief Investment Officer. So we thought this would be a great opportunity for everybody to see all of us together. And we wanted to go through what happened in markets this week. So I thought it'd be great to start with some of the economic data. So, Gary, what have we seen this week in terms of economic data that sort of caught your eye?
Thanks, Aya. About a week ago, we got an update to gross domestic product. That is the GDP number, which it's announced a couple times. The first time it was announced about a month or so ago, it was a contraction, negative 0.3%. First time we've had a contraction in a while. And while that garnered some headlines, it was pretty well telegraphed what happened. There was a ramp up in imports, which is a detractor from the GDP calculation. A lot of businesses were trying to accelerate their imports to get ahead of the tariffs. And of course, that had an outsized negative impact. And so the slight modification to that GDP number, now it went from zero point 0.3 to 0.2, slight uptick in the right direction. So directionally, or overall, not a significant change, but directionally important because it helps demonstrate that, in fact, if you took away that one event, GDP really overall had a relatively positive quarter outside of the import factor. The other event or news that was noteworthy was, of course, inflation. We talk a lot about inflation, both on the CPI front, which is the number that most of us are more familiar with because that's what affects our social security payments. But PCE is what the Fed cares more about. That reflects more what people actually spend. And if you look at the core PCE number that actually extracts food and energy, it was up 2.5%, which was this in April, which was the second straight month of inflation coming in softer than expectations. And we've seen this pattern before. Actually, last year started the same way, where we saw the start of the year, we saw some higher, hotter than expected inflation numbers, and then things kind of quieted down and normalized. So what that means is that inflation is not running rampant, which is a good thing, of course, and it also has implications for the Fed. If you look at the futures, we're not expecting the Fed to lower rates anytime soon. The probability suggests something like a 97% chance of holding the rate steady in June, and probably the next cut, as of now, wouldn't come until around September. Doug, what did you see last week?
Yeah, there was a couple great, positive signs for the consumer. First, a widely followed sentiment index, the University of Michigan Consumer Sentiment Index, was came in higher than expected, and that's probably the first time in several months. I know we've talked a lot about this when we've all done these seven market movers. That sentiment really declined as all of the unknown around tariffs and inflation really tamped down what the consumer's expectations were, and so it's nice to see that come back. Alongside that, I think importantly was also the JOLTS, or the jobs opening numbers. And you might say, well, why is more job openings good? Well, more job openings means that companies are actually coming back to the table and thinking about growing again, right? They say, we're gonna hire, right? We want to hire because we have expectations to do more. And so the JOLTS number, which tracks job openings, came in 290,000 more than expected. And so I think the market saw that and said, okay, maybe the economy is absorbing this headline risk. We're still waiting to see the data, but it's positive to see that both consumers are feeling better, and clearly, at least one mechanism of businesses feeling better is the fact that they're opening up more jobs. And so those two I thought were an interesting tidbit.
No, absolutely. And I think with that, we did see the S&P 500 tick up about 0.7% for the week. We saw the Russell 2000 up 1.5%, and we saw the NASDAQ up about 1%. On the fixed income side, we actually saw yields come down. So we've actually seen the 2-year yield come down about 15 basis points and the 10-year come down about 20. So I think these are all reflecting really positive indicators in the economy and in the markets. And with that, we're going to wrap it up for this week's Seven Market Movers. Thanks so much for joining us, and we hope you keep enjoying these videos.